Hello, everybody. Welcome to Friday. Looking forward to our session today, as always. Excited to see those of you here who are here. Hopefully, we'll get a few more coming in as we get things rolling. Been a couple of weeks. Good morning, Jay. Glad to have you here. A couple of simple things here, just by way of managing. If you want to interact with me or with the group, you can do that through the chat. I pay attention to it throughout the course of the session, try to answer questions, and use that to spur discussion as well. Um, so please feel free to take advantage of that and use it. Also, good morning, Gib. I'm glad you got. I got your email this morning. I apologize. There was a mistake initially when I send out the alerts for the live stream. I copied an old link and I corrected it. I'm glad for those of you who have joined. So I'm grateful for that. Just one note. So last weekend we took off because of the Black Friday weekend, and that meant I opened up whether or not we would have that live stream to the group. So those that were here got a chance to vote. Um, Christmas, the week of Christmas, the day after Christmas is when our live stream is scheduled, and so that is December 26th. Um, the market is open, which means it's a normal day of operations. If you would like to go ahead and plan on having that session, I am certainly happy to do that. Um, we can also leave that to be an open question until the week before, and I'll ask for the same thing as to whether or not that's something that you'll want to do. Okay, you can also help this live stream grow and help Rebel Income grow by doing simple things like liking the video, sharing it with people that you know, and inviting them to come. This is publicly available. Previously, this was only for members, but I've since made it available for everybody. So if you know somebody that you think would benefit from the things we talk about, please feel free to invite them, share the link with them, and help me grow the community. Okay, let's go ahead and dive in. As I mentioned, it's been a couple of weeks, and there's been a lot of activity going on in the market since then. And so we definitely have a lot to talk about. Uh, it is the first week, the first Friday of December. That means that I do have some trades on deck that are set for expiry today, and a lot of others coming up before the Christmas holiday. So we'll go ahead and dive right into those. I expect we'll probably have some time to talk about some of the things that some of you may have been following as well. And so we'll see kind of where the discussion takes us. As always, if you have questions or comments, please do use the chat area, just as Jay and Gib have, and let me give me an opportunity to respond to those questions or comments there. So let's go ahead and start with the first trade that I have on deck, and that is a put sale on Nike that I placed in the second week of November. This was basically a 3-week trade, selling the $62 strike price and bringing in a little over 2% for that trade for the 3-week time period. That's a nice setup in and of itself. But let's go ahead and check in on the stock and see how things are going. Okay. So stock has been showing a nice little rally for the last couple of weeks, and that's certainly been a good thing for our trade. My put sell, my strike price is down here at 62, so we have a fair amount of room. The stock is tracing back today, so it is if it picks up a lot of momentum here in the next few hours, it is certainly possible that I could still be assigned. But by all reasonable measures, it looks like this is likely to expire worthless. That is considered to be kind of an ideal result for a lot of people who work with put selling trades and income generation. This is just a result in my book. It's not a bad one by any stretch, but there's a lot of different things. One of the things, if you've paid attention to my alerts, that I always try to make sure to state is that the strike price that I'm selling is a price that I'm willing to buy the stock at. So in this case, 62 is a price for Nike that I thought represented a really nice value in a company with really solid fundamentals and a value proposition that is well above that level. So this is a good result, means that the capital that I have put into the stock will be coming back to me. But it also offers an opportunity here. And again, this is if you've been following this trade, and you can feel free to throw in your numbers if you've been working with this stock as well for comparison purposes. This is also something that you've probably, if you wanted to try to manage this trade a little bit more actively, I wait till expiration. I see what's going on. If I'm going to be assigned, I generally don't avoid it. I accept assignments pretty actively, and because these are stocks I like. That's why I sell the price that I do. I'm also looking for opportunities to add to my portfolio. These are good fundamental companies that pay useful dividends, and the passive income that comes in from those is a useful part of my strategy. That said, there may be an opportunity here with the stock at 65 versus the $62 strike that I sold to try to manage this a little bit more actively. This isn't necessarily aggressive. This is just more active, because what you're doing by buying an option back before it expires is you're minimizing the time delay associated with trade settlement. By letting the trade run through to expiration, which is the end of business today, that means that the $6,200 for the one contract that I sold on this stock, that money doesn't become available to me again until the trade has gone through normal trade settlement through my broker, and that's typically about 1 to 2 business days. So that means that the earliest that money is going to be available to trade is going to be Tuesday. That's part of the reason I post my trade alerts when I do. I'm used to working with that trade settlement, and that actually works just fine for my system. But if you want to if you want to be a little bit more active, sometimes there's good opportunities to do so. And let's keep in mind here, when I sold this put option, I brought in a credit of $1.30. So this was the premium that I brought in by selling the put option, and this option has had some activity, and the bid ask is 1 cent, 2 cents. So that certainly means I could buy this back. I could do a buy to close order and still hang on to 99% of the premium that I brought in, and the cash that I put in to reserve the trade would come back to me immediately as soon as this trade clears. Then that money would be available again for me to redeploy. That's useful, assuming I have an idea of what I want to do with it next. So, with that in mind, let's take a look at some of the other expirations that are available. With the stock moving up a little bit, there may be an opportunity to buy back, maybe roll forward in time, as well as possibly up in price, and keep the income generation machine going. And to that point, here we have the stock just a little bit below 65. So 64 is the first in the money option contract here. This is 1 week out, 78 cents on the bid. So there is a sell to open opportunity here for a 1 week trade with the $64 strike to bring in a little over 1%. That's interesting. Let's look at the details on the contract. Yeah, there's certainly enough open interest on this to make this a possible trade. Look at the 76. So the bid is asked. The bid has changed just a little bit. Yeah, Barry, we'll definitely get to target. Yeah, it took off for a bit, so you got in for $90 as it was trading over 92. Yes, it had some days where uh, its up days were pretty impressive, and the down days were a little bit more volatile than normal, but not as big as the up days. So that one's been interesting for sure. We'll run some numbers by comparison. So, and Jay, you bought Nike at 69 on October 8th. Okay, you've been selling calls ever since. Yeah, that's awesome. And the stock is a little bit below that now, right? But if you've been selling calls, you're probably in a pretty nice position on a net basis on this. This is interesting because this is a little bit like one of the things that's interesting about covered calls and put sales is depending on if you own the stock or not, these kind of become like paying yourself a dividend on the stock, right? Jay, your cost base 65.76. So yeah, that's awesome. So you're not too far from where the stock is at right now, and you've been managing it pretty nicely ever since then. Barry's in at 62, and you're okay. Your latest call brought in $1.57 expiring today. All right, awesome. Or sorry, that's your put sale. So you did a little bit better than I did. So Barry, you beat me. That's awesome. That is exactly the kind of result I like to see. This is again this 1 week trade here. I know that for the people that are here, this might sound kind of obvious, but if you're listening to this live stream after the fact, I just want to. It's always useful to consider. Give me just a second. Sorry, my screens went ski-wampus on me for a second. Okay, it's always useful to consider some of these alternatives in a really practical context, or as practical as we can make them. These numbers are going to be a little bit simplified and idealized, but you might look at this and say, why is he talking about selling a put option and only bringing in 76 cents? That sounds really lame for a week. That's just a little over 1%. Well, it's a little over 1% for 1 week of time. That's the great thing about put selling and covered calls here is when we sell short-term options, we have an opportunity to take advantage of time. Options have a built-in time decay that can either work against you if you're an option buyer, or it can work for you. And by being the sellers, we're trying to take advantage of that time decay element by not only placing very near-term trades, but also taking advantage of what time decay does on an aggregate basis. The closer to expiration an option gets, the more time decay erodes, and so that creates situations like this contract for next week, where a lot of people just aren't even paying attention to it. But there's still an opportunity here to bring in a little over 1%. So let's run the numbers here and show you what I mean. 0.76 is the premium here, and this is on a $64 strike price. So if I sell this contract, I'm giving somebody else the ability or possibility option in the next 7 days of putting the stock to me at 64. But if I still like that as a value price, that's all right. And I bring in 1.18%, a little over that, for a 7-day trade. Okay, 1.18% by itself doesn't sound very awesome. Sounds pretty minimal. But when you factor in the time element, what you get here is the ability to place another trade in 7 days. It is true if the stock is below 64 in 7 days, I could be assigned. Now, I'm not actually saying I'm going to do this, make this trade. This is not a recommendation to buy or sell, yada, yada, yada. But this is a really, really good example of the compounding effect that you can put in place with put selling and covered calls. So when I think about this 1.18%, I'm just going to simplify it to that. And I think about that on a yearly basis. If I can do this every week, remember, we're talking about 52 weeks. This is the possibility of generating up to 62% return on the capital that I'm reserving for the trade on a yearly basis. Now, are my numbers actually that high? No, they're not. The truth is that the amounts of time that are available to sell and bring in practical income vary. And so sometimes I'll sell a week, sometimes two, three. I tried not to go out more than about 4 weeks in time in any case to try to take advantage of the opportunity just to keep the normal pace of my put selling trades in order the way that they have been. But sometimes you get the opportunity to accelerate this the way that I'm talking about, and where I may wait for 3 weeks on Nike and be content with that result, by the way. I like just the fact I brought in 2.1% for that 3 week period, and there might be another opportunity to do it again, maybe next week. I don't know yet. We'll see what it looks like on Tuesday. I'm okay with that result. But that also means that I don't get to place as many trades with the same capital. So this is really all about thinking about the capital that you're deploying and how often you can keep it working for you in creative ways. Those people who are part of our group and some of the people I know that are really active income generators really, really make a lot of music, I guess, by leveraging by leveraging this rolling option, this ability to manage your trades more actively, this acceleration of compounding. If you can bring in 1% or even a little bit under that for a 7 day period, and you can repeat that again and again and again, what you get is a process over time that really can compound your growth and expand your results and build wealth a lot more, or well, maybe not a lot more, depending on how it goes, but certainly to a greater extent than I know I have been able to do with traditional growth strategies. Buying a call, buying a put, those are very low probability kinds of trades. You might be right maybe 25 to 30% of the time. And that's being pretty generous, to be honest. I've had stretches where my results were far, far lower than that. With this one, with by taking the selling side of the transaction and focusing on trying on this compounding effect, um, my results, my success rates have gone from 20, 25, 30% to over 98%. And that's not an exaggeration. You can look at my trading log. I share that with everybody through my Substack page, through Patreon, and through Discord. So you have free access to that. You can see exactly what those results are. Um, but these are real numbers. So when I talk about picking up the low-hanging fruit in the market, this is where it is. This is these are the trades that the majority of average investors are just not paying attention to, but that are available in a very, very real sense. And Jay and Barry have shared some of their results that they've been able to see just in some of these recent trades too. So I'm not the only one that is playing this tune. Okay. So that's Nike. I'm going to go ahead and let this expire worthless. That's fine with me. I don't as much as I've just elaborated on the advantage that you would get by this more active trading approach. Uh, I'm actually a lot more passive. I let the option expire. If I get assigned, I get assigned. If I don't, then come Tuesday, I look for another opportunity. I'm okay with that because I'm not trying to match any other person's results. I love it when you beat me, when you find ways to apply these methods in your own way, and you get better results than me. That's awesome. But really, in terms of when I'm talking about this and sharing these strategies, I'm also really talking about how we each operate our own systems. So for me, letting the option extend through expiration works. It gives me more than the results are more than enough for what my needs and my purposes are. In all honesty, it makes it a little bit easier for me to manage not only my trades but also the information that I'm sending out to all of you. So, uh, being a little bit more passive means I am tacitly and actively giving up a little bit more return, but that's okay. What I'm doing is good enough for me, and that's really, when all is said and done, the main question. What is enough for you? This is another thing that I really, really like about income generation is it helped me to really think about what I not what I wanted out of the market, but what I needed from the market, and to find a way to get it. When you're working on the buying side of the market, whether you're talking about buying a stock or you're buying options, there's a tendency to kind of chase the market, chase other people's results. And it's easy to get caught up in the emotion that happens when you happen to hit a really successful trade. Maybe you hit the proverbial three bagger or four bagger or whatever. You got that nice home run trade. It's really easy to get caught up in that and go look for the next one as soon as you possibly can. It's kind of a trap, because of the way that the probabilities work. If you're only going to be right 25 to 30% of the time, yeah, you'll have some winners, and those winners can help a disciplined trader on the buying side be successful. But you have to also factor in that if you're going to be wrong more often than you're right, you're going to go through periods where you're going to have several losing trades in a row. And those losing trades are the killers. Those are the ones where emotion and objectivity really get challenged. And so, speaking for myself, I learned, even though I had all of the technical knowledge and conceptual knowledge about how to make those trades work and be successful, from an emotional standpoint, I found it really, really difficult to avoid the temptation to chase and to compare what I was doing with somebody else. Income generation, on the other hand, makes it a lot easier for me just to take things the way that they make the most sense to me, and to take the market on my own terms. I guess is really what I'm driving at when all is said and done. I hope that helps. It's a little bit of a ramble, but that's one of the things that I think is important about trying to figure out what your own investing system is. It's not about you're not trying to match what I'm doing. You're not trying to beat what I'm doing. You're just trying to find what works for you or what anybody else does. I tried that. I've tried that so many times and caused myself so many problems. I just lost interest in trying to copy somebody else's method and trying to recreate what they were doing on their own. So this is what helps me to be able to get what I need from the market. All right, I'm done with that little soapbox. Let's move on to the next trade, and that is FCX. This came the week after my Nike trade. This is a stock I've used a couple of times in the past. I sold the $39 strike price, and brought in 75 cents. The return not quite as high as for Nike, 1.92%, but this is also a 9-day trade. So this is a really good example of this compounding by leveraging shorter amounts of time. Um, the Nike trade was a 23-day trade. This one's a 9-day trade. So I sold one contract at the $39 strike price. That's $3,900 that I had to put on reserve for this. This is also setting the price that I'm willing to buy the stock at. FCX is Freeport McMoran. This is a mining company. And I kind of like mining companies, I'll be honest. Especially when economic conditions are a little bit uncertain, they give you an opportunity to kind of use them as a proxy for precious metals. So Freeport is obviously rallying pretty nicely right now. There we go. Up here at about 45.57, and in my ramble, yeah, here's I sold the 39. So my strike was all the way down here. So we've got a pretty healthy distance between the stock's current price and the strike price that I sold. So this is going to expire. This is going to expire as well. This could set up an interesting opportunity to think about whether or not to do this again. This rally, however, while this is fun, and if you bought the stock and you've been able to watch this, then this is the kind of thing where you get kind of excited. As a put seller, if I sold the $39 strike price and now I've seen this kind of a rally in the last 5 days, I've got to think about what my next trade might be if I want to keep working with Freeport. And the technical reality that the stock is starting to approach resistance. It looks like it's a little bit above 46 here. That increases the likelihood that the stock is going to hit that resistance and start to move lower. Retracements and drawdowns off of rallies and within trends are very, very normal, natural, and even healthy things. We've got a stock in this case that had been following a very clear downward trend. This is the 200-day moving average. So this is a long-term downward trend. And what we've been seeing really since May is a very gradual consolidation and flattening of that trend that has only really in the last week or so begun to bend upward. So is this starting a new upward trend? Very possibly. This does look like it could be reversing and starting to move into a much more sustainable trend in the longer term. But right now, what we're seeing is really nothing more than a very, very short-term trend in terms of this latest rally. In order for this kind of momentum to sustain itself over time, you would almost have to expect to see the stock pull back a little bit. Expect speculators and traders to start taking profits here at some point, see the stock trace back, find a new floor, possibly around here, a little bit above 42, and then bounce higher and start to go back up again. And if it can break up above this resistance at around 46, then I would expect to see a lot more upward momentum. That this trend would become a lot more sustainable. Okay, that's a fairly long technical description of what the stock may be doing and may be setting up for right now. How does that translate to our trades? My put sale is obviously in a good place right now, but if I want to think about if I want to think about using FCX for another trade, I've got to think really carefully about where the stock is at now, because it should be really primed to pull back, at least in the very near term. Now, that isn't a bad thing. As I mentioned, this is going to be necessary for the trend to show any kind of longer term bullish strength, right? It will be for there to be a very short term downward trend. But what it does should force me to think about very carefully is what kind of price I would want to work with for my next put sale. It's not a given necessarily that I'm going to want to go all the way to 45. It kind of depends on what's available. So all of that is a great big long segue into seeing what the options are doing right now for FCX. So all right. I'm going to need to expand my strike prices here. Here's the $39 strike price that I sold. Asking price of 2 cents. Literally speaking, I could do it for probably 1 cent, and I would probably get that. Barry's got a call on Bristol Myers expiring today, and Intel. All right, looking like they're both going to get called out. Good, that's awesome. That's another positive result. And Barry, I will make sure to come back to both of those. So thank you for highlighting them. So that's where this contract is right now. But if this is likely to expire worthless, I need to think very, very carefully. If I want to keep working with Freeport, do I really want to go all the way up here to where the stock is at now? 45 is offering a tempting result. It's offering a tempting premium, a little over 1%. Again, we just talked about the compounding effect, and that's kind of tempting right here for 1 week of time. However, what are the chances in the next week that the stock starts to trace back? I would say pretty good. Now, if I still believe that the value proposition for FCX is way above 45, and my analysis says, in all honesty, that it is, maybe this doesn't bother me. Maybe I'm willing to say, yeah, it may pull back a little bit, maybe to 42, whatever. But, if I like it at 45, here's an opportunity to maybe go ahead and buy the stock and generate a little bit of income here. And I'm okay if it drops a little bit below it. Yeah, Barry, thank you. Probably enough not to chance it if you don't. That's 7 days. But here's if we want to think about it in slightly different terms. Now here's 14 days. Here's the week before Christmas. We were just looking at 45. Now here's 44.50. There's 75 cents available, 450 cents below that 45 level. So you go down a little bit, you're possibly securing a lower purchase price if you do get assigned. Again, now you're going out 2 weeks. That doesn't increase the likelihood necessarily that you're going to get assigned. It just you're still working within what I would consider to be the ideal 1 month time frame. You're just going out a little bit further in time in order to get a little bit more premium and give yourself possibly a little bit more breathing room in terms of the strike price that you work with. Here's 3 weeks. Let's take a look at that one. 44 is 59. That's in. Yeah, you got to here now. You're talking about seeing the difference between bid and ask prices starting to spread out, which almost always means that there's not a lot of activity going on here. Well, this one's interesting because there's enough open interest and enough volume here, but you still got a really wide spread between these two. That's really interesting. Looks like the asking price should be closer down to the day's range, which is about 80 cents. They just haven't closed that gap. If I go out a month, go down to 43 possibly. Now you're starting to get into the range where I would expect to see support around possibly 42, 43. I would say 42, probably not enough activity or premium to make that one interesting. 44 has 75. So all depends on what you think would be reasonable. And if you don't like any of these, that's okay. Maybe you go ahead and you put FCX aside for now. And this is this is a more than acceptable decision, by the way. Let's say that I bought my contract, my 39 contract back right now so that I had that money available, but I saw all these numbers and I said, you know what? I don't like any of them. I'm going to sit on my money for now, and I'm going to wait and see. Not necessarily just for FCX. I'm going to maybe look around at some others, maybe Nike, maybe some of the other stocks that I've been analyzing lately, and see what else is out there. And maybe sometime next week I check in on FCX again and see if it's managed to maintain this momentum, sustain it. Maybe it's begun. Heck, there's always a possibility that it could just kind of start to drift. We see these all the time, right? These consolidations where they just kind of start to hover in a sideways range. It could start to do that. It could pull back a little bit into some of the regions we were talking about previously. But any of those dynamics might change the way that the options look enough to make a trade more practical at those levels. I'm trying to this is the art part of trading, is trying to find the right balance between technical momentum and the technical setup you see on the chart versus the income that is available at different strike prices. You know, what is the opportunity versus what you think the overall technical setup is. A pure value-driven investor would not worry about the chart. They simply are going to say, if FCX is worth 20 to 25% more than the $45 strike price that I might be buying the stock at, that's all I need to know, and that's fine too. I'm trying to kind of split the middle, and sit in the range in between. I'm trying to find balance between what I see on the chart and what is available from the option chain, and find the range and level that I'm willing to work with on those terms. And that's okay too. There's nothing wrong with doing that. Okay. So that's Freeport. And then there's really only one other trade here that is set for expiry today. So this is going to Barry. We're gonna check in on one of your trades here, and that's on BMY. This is a covered call that I sold in the last week of November at 46.50. And just to be clear on this one, I was assigned the stock at the end of September at 46. Now I've had an opportunity to sell, make a couple of covered call trades since then that have been useful. And so this latest trade was just one more opportunity to keep the income generation machine going with the stock. Bristol Myers is a really good example of the reason that I don't avoid stock assignments, is that sometimes you get these opportunities not only to sell a covered call very soon. Excuse me just a second. Not only to sell a covered call very quickly after an assignment, but sometimes you will get multiple opportunities to keep the covered call machine going. Jay mentioned that he's been selling calls on Nike ever since October. That's another one, really, really good example of why I think taking assignments is a good thing. Especially if you like the company, they're paying a useful dividend. The cover calls just give you an opportunity to add another. You're kind of paying yourself a dividend here, and you keep that income generation going. That's why a lot of people. I have a lot of people. I've talked to a lot of people who kind of laugh at covered calls because they say, "Why do you want to sell a call against a stock that you own? You're putting a cap on how much money you're going to make if the stock rallies." The only reason you get called out of a covered call trade is because the stock has moved above it. Well, what if, I sold the 46.50 and the stock is way above it? Well, to be clear, looks like that's the case. Let's check in here. Wow. Just look at the last 3 days. Seeing a big surge here just since the end of November. This is what set up the covered call trades that I've been placing throughout this period. I've been fortunate to have several of these expire worthless, but my covered call trade is all the way down here at 46.50, and the stock has really lifted off since then. Now I'm up above 52.12. So here's where people will laugh at me and say, man, you are giving up almost $6 of capital gains. Yeah, I am. I'm actually okay with that. And the reason I'm okay with that is there is no crystal ball. I've already placed multiple really useful covered call trades on this one. And as a result, my overall net result is actually pretty nice if you just think about it within itself. We'll run the numbers there in just a minute. But when I say there's no crystal ball, there is no way to predict that this is going to happen. Yeah, Barry was assigned at 47 in September. He's written 3 calls for a total of 257, and he's got a $3 capital gain baked in. And so, what Barry has here, I already gave you 2 tick marks. And I'm going to give you a bigger third because this is Barry. You're giving a perfect example of exactly what I'm talking about. He's getting a result of almost $5.50, a little over $5.50 net profit after the covered calls. And that was not waiting on the hope of seeing this happen. This was just taking the premiums that were available. That's the 257 in income. Those are the known quantities that are just out there waiting for somebody in the market, some smart trader to pick them up. That's the low-hanging fruit. He was able to set that up, and now even with his selling price at 50, his net result is nearly, actually, considering your $47, this is the strike price that he was assigned at. If you think about it, Barry, your result is actually better than somebody who bought at 47 and is now looking at the stock at 52.29. He did that by not saying you're always going to beat the growth investors in these kinds of cases when the stock starts to really accelerate, but you can, a lot of times you'll still be in very nearly your overall position will be pretty competitive. Okay, let me show you. Let's show you my position by comparison. So here's my original purchase at 46. This is where I was assigned. My first covered call came a little bit later. Right here, I sold the 40, sold the 47 strike price and brought in $1.05. So here's covered call 1, was $1.05. This was a net credit on my account. Okay. The second covered call, this was the first one right here. And the second one came right here at the first week of November, bringing in $1.01. So covered call 2. And then my most recent, this is that covered call expired just before Thanksgiving. And here is my most recent one. I sold the 46.50, brought in $1.22 on this one. Yeah, Barry, you also brought in 94 cents on the $47 put. Thank you. We don't want to ignore that. I brought in 75 cents on my initial put sale. Okay. Sorry. I do know how to manage my tools here. Here's covered call 3 plus $1.22. And my put sale, I brought in 75 cents. So when we take all of these together, $1.05, $1.01, $1.22 plus 75. So I've been able to generate $4.03 in overall premiums. That's income. This was just the money that was out there in the market waiting for me to grab. I've got a 50-cent capital gain on top of this, so 453 is going to be my total net gain, and it's not going to be any more. Oops, that's not right. So 453. Okay, when I divide this by my $46 strike price that I bought the stock at, that's 9.84% for a trade that I've held for just a little over 2 months. Now, again, in my case, this is a little bit less. You can look at the stock here and you can say, okay, great, you got in at 46 and you've got this 9.87% result. That's fine. But if you had just had the sense to buy it at 46 and hold on to it, you'd be up more than $6. That's a lot more than that's more than 10%. So you've given up something. Yeah, you're right, I did. Again, there's no crystal balls. There was no way of knowing that was going to be the case. The proof of that is in the covered calls I had placed previously. My first covered call, here's a $47 strike price. The stock had rallied pretty nicely. I had a potential $1 capital gain built into that trade on top of the premium I brought in. Same with the next one. I have a covered call on Skyworks not too long ago here at 77.50. I bought this stock at 75 and had an opportunity to sell a covered call here, bring in a really nice result with $2.50 of capital gain baked in that didn't work out. Sometimes that happens too. So this is really not necessarily about trying to look into the crystal ball and forecast and say what's going to happen as much as it is simply, rather than it is simply just seeing what is available in the market, looking at what is out there waiting to be picked up and having the sense to pick it up. All right. I beat that quite a bit. Let's talk about next week's put sale on Delta Airlines. Now, I sold the $61 strike price here. This is a trade that brought in a little under 3% for 2 weeks. This is kind of an outsized result compared to normal conditions. Delta had been pretty volatile around the holiday season. People were gearing up for holiday travel. And again, we've seen a really, really nice result here. So I'm at 61 is the strike price that I sold, with the stock up here at 67.54. This is almost certainly going to expire worthless unless we see a really major drop back here. I'm at 61, and that's right around, if the stock does start to retrace from this big rally, which is possible, it may come down here to around 62 before finding support. That's not outside the realm of possibility at all. That actually would be kind of nice. I wouldn't mind actually taking some shares in Delta and having some opportunities to keep working with its options. That implied volatility does some fun things sometimes for income generation. So let's take a look at the contract that I've got. Expand this out, make sure that I can cover it. Here's 61. Okay. Let's close out today's contracts. Let's look at next week. So keep in mind here, $1.72 is the amount of money that I generated here. So here's $1.72, and I know that's ugly writing. I apologize. But here is the $61 contract, has an asking price 49 cents. That looks a little bit outsized, not only because of the distance between the bid and ask, but also relative to the other asking prices of the contracts are rounded above and below. They're a it's a little frenzied, a little disorganized and disjointed. This is definitely a reflection of the fact that there's been no activity. There's been no trades on this one. As we can see, there's enough open interest here though. So what does that mean? If I wanted to not mess with, if I didn't want to mess with this, I just wanted to take advantage of the fact there's enough open interest to have my put option bought back from the market. I could put in a buy to close at 49, and that would mean $1.72 minus 49. I get to hang on to $1.23 of my premium, which is still more than 2%. Divide by 61, a little over 2% for a trade that I placed for 2 weeks, and I shortened it down to 1 week. This is a really good example of where that opportunity to accelerate income generation by trading frequency, increasing the compounding effect, starts to come in play. I had a little under 3% for the 3 weeks. Now with 1 week left, or 2 weeks, excuse me. Now with 1 week left, I could buy this back and still have about 2% and have my capital come back to me right away and available to deploy in a new trade. Well, what would that look like? Now, if I wanted to stick with the stock, I wanted to maybe work with the same expiration date, maybe next week. Let's say that I was willing to go up here. Again, implied volatility on these options is still pretty high. Here's $1.07 for the $67 strike price for 7 days. That's not terrible. $1.07 divided by 67. It's 1.5%, about 1.6% for a 7-day trade. When you add that to the 2%, 3.5% roughly for about the same period as the initial trade. Possibly. That's assuming that the stock is going to hold up here in this level. And again, if this is something that I'm willing to think about doing, the question is, am I willing to own the stock at 67? Am I going to be okay with that if I see the stock start to taper back, which again would be normal and healthy considering the amount of room that it's covered during this rally. A little bit of a taper would be not only normal but healthy. Give it a way to find a new level to stay. Excuse me. A new level to stabilize before rallying higher. So, not a terrible thing. My other trades are covered calls and this week's put sale on Target, which Jay already referred to. I sold the $89 strike on that one and brought in $1.52. Again, that was just an opportunity to just work with a stock that has been a little bit volatile, even though the chart doesn't. This looks kind of unimpressive, but on a day-to-day basis, it's offered some interesting. It's offered some interesting alternatives in terms of the income generating trades and positions to work with. So let's in just a couple minutes that we've got left, I want to go back to Barry's comment about Intel. And this is one that has been riding some of the same momentum we've been seeing from, say, Delta and Bristol Myers. Big rally up here initially from 34 up to a little, this is probably about 44. And it's tapered back since then, now at about 42.33. So, Barry, you've got 40.50 is your covered call, which is all the way down here. Again, giving up a little bit of capital gain. I know, if I remember right, though, Barry, your entry price on entry level for Intel was quite a bit lower than that. Yeah. Jay on Target sold the 87 put. I sold the 89, so you got a little bit lower. You beat me. You made that trade a little bit, gave yourself a little bit more room to work with, so I'll give you a tick mark there. Yeah, Barry, cost basis is around 32, so getting called out at, and less time. All right, Jay, you got it, man. I love it. Shorter time, more conservative trade, perfect. That's awesome. And Barry gets a nice result here. He bought Intel at around 32, and with his covered calls, he's been able to generate some nice income, I know. And getting out at 40.50 means you got a nice you've got a nice capital gain, a little over $8 on top of it. So again, that's a nice result. Um, I'm still hoping for Intel to get a little bit higher. I'm not going to lie, because I was assigned at a much higher price a while ago. So, been writing nice calls recently, all 3 contracts at a time, times 3 lots. So that's awesome. All right. Well, everybody, thank you. We are at time. I appreciate everybody's participation and attendance. Thank you so much. As I mentioned before, please feel free to share this live stream with your friends. Share Rebel Income. Send them the reports that I publish on Substack, and those are available for free. And as well as the trading alerts. Now, those are people do need to pay for those, but that's okay. I'd like to try to keep the community growing. But I hope everybody has a wonderful weekend. Yeah, Barry, there was an error with the initial email for this live stream, and yeah, it had the incorrect link. I updated it. Hopefully, send out a notice to everybody right after that. But I apologize for that. I'm just going to chalk that up to turkey coma. A little bit, and appreciate the fact that everybody was here and for your participation. So, okay, you said that to a friend yesterday, so they may be listening to the same one. All right. Well, thank you for sharing that, Barry. I really do appreciate it. And again, I will do better as we get further past the Thanksgiving turkey. Our leftovers are done, so I don't need to worry about turkey comas anymore. Hope everybody has a wonderful weekend. If there are any questions between now and next week, don't hesitate to reach out to me. You can email me at rebelincomesystem@gmail.com, or message me directly in the Substack app. Or if you're on Discord, you can message me there as well. Either way, you moved on to chili. It's getting cold enough. A nice bowl of chili sounds really nice. So, especially for a tailgate, late season football and chili, right? That's nice. All right, everybody, thank you again. Hope you have a wonderful weekend. We'll talk again next time. For all the championship games, that's right. Thanks, Barry.